if you're a loan officer looking at a new company. So you're either a brand new loan officer or you're looking to make a change. How important is the interest rates that they show you in regards to your switch? I would contend that it has to be less than 30% of your decision making for several reasons. One of which is that what they show you very well could be for the first 3 to 6 months. It very well could be just what they show you and they're not being super honest because they just want to get you over, right? Let's hope that's not the case, right? But I've seen that happen before. What you're seeing that day and the company as a perspective from, say, hey, let's jump onto a Zoom call and see where your rates are at. I just don't think it can be more than that 30% of your decision making. To be honest, I think it should be less than 10%. You need to understand the leadership. You need to understand what's the company's goal. Do they want to have 1,000 loan officers? Do they want to have just a very specific style of loan officer or a volume goal or something to that perspective? So my point would be is that looking at the rates, it just cannot be a big portion of your decision. Now, what you do absolutely positively need to understand and be careful is if you have a very specific niche that you work in, maybe it's VA, maybe it's FHA, maybe it's something else, understanding if the company has any overlays to make sure that the sort of business that you're bringing in isn't going to be limited there, and understanding those sorts of products are supported by plenty of underwriters, by good market interest rates as well. So if you have a pretty wide depth of your business or your market, then I would contend that probably more like 10%. So hope that helps.